Welcome back to another Market Insight call. It's the last one of the year, joined as always by Aaron Tuttle. Thought it'd be great if we just went back through what happened this year. There was a lot to learn from market reaction, things we saw in the economy throughout the year.
I'm really excited we got our Christmas colors in for the last one this year.
Looks good. I wore the closest thing I have to match it. Heading into 2024, 2023 was a really strong year for the market, and it was actually pretty contrarian to think that would continue.
Yeah, absolutely.
Our outlook for the year was actually called status quo, the idea that we thought it would continue and be similar market reaction from similar sectors, which is largely what we've seen so far this year, where we started the year with a call with Jeremy Schwartz to go through the outlook, where he largely agreed with what we had to say.
So if you haven't done so, hit that subscribe button so that you don't miss that. We're actually going to go over a report card because we had our predictions for 2024, and we'll see how that turns out. The year isn't over yet, so we can't say who's won, but it's looking pretty good for a lot of those calls.
My favorite part about our outlook with Jeremy last year was something that we actually weren't able to record. The SEC had just approved Bitcoin ETFs the same day we were recording. He was not allowed to talk about it and record on it, but he did give a lot of insight about, he'd been working on that for a couple of years to try to get that approved. And one thing he said, really simple model, simple framework for thinking about it. He said, you guys are the next trade in Bitcoin, right? It's not, we'll talk about a stock later of ours that we've liked for a long time, Broadcom, where you can forecast out earnings and get reactions to outperforming based on forecasts and earnings. Bitcoin, you just need the next buyer, right? Could the next buyer be U.S. Treasury, some government agency? We don't know, right?
Sure.
They're certainly pricing that in. And of course, there are other ways to buy Bitcoin. But he said, the next trade is these ETFs.
Yep.
And if you see large adoption, you're going to see a rally. We actually haven't been getting a lot of questions from clients. Probably a good sign that it's not necessarily a bubble. When everyone's talking about it, it's usually when you have bubble signs. But simple framework, are other people going to be buying Bitcoin? And generally the answer is probably not yet, at least for our clients. There's not that that need, that ask for it, at least.
And it's just that simple supply and demand. Demand was going to go up as more people had access through different channels. Makes sense.
Another interesting that happened in the first quarter was Sam Bankman-Fried, sentenced to a 25-year sentence for FTX, running essentially a Ponzi over there. That the depositors were made whole was the headline. Of course, if you read a little bit deeper, they were not made whole. They marked the portfolio low when the liquidation trust took over, so they were able to get a rally in Bitcoin, pay back the creditors at a lower price because they marked them low. So it was not actually made whole. And the first quarter of the year was really strong. Seasonality held. January, February, and March were all positive. And we show here a chart we show often, which is just the average monthly changes going back about 100 years. And we can spend some time here to look at where we are now as well, not just Q1. November, December, and January tend to be really strong months, especially in December. Mm-hmm. Talk a little bit about Santa Claus rally and really what we think we should do with the time, which is probably do some rebalancing, look on some other areas that have not performed. Then we move into Q2, where it really became the war plan, right? Middle East, everyone's talking about Israeli defense systems as they're going off every night. The S&P had a 4% down month, strong reactions. Something you talk a lot about is short-term trading metrics, which is when they hit a certain signal, the RSI, which we quote, you just have to close your eyes and buy. Did not quite hit that number. That number's in RSI 30, it was 35. So sell-off was strong, but not quite at that point where you close your eyes and you buy. Something you learn, and we go through the data, and the data are tough on wartime versus peacetime. But speaking of Jeremy Schwartz and in his book with Jeremy Siegel, they talk a lot about what happens in long-term returns in wartime versus peacetime. And the conclusion they came to is that nominal return, the return you see, is actually the same. Very, very similar in the long term. Just the real return is not the same. Wartime has higher inflation, so you don't the return you actually feel, the real return, is lower in wartime versus peacetime. But at least from the standpoint of what reaction should you do, it's really stay invested because the returns are pretty similar.
Right. They're the one things that are going up, and that's going to offset the inflation impact that you're having that wartime. Makes all the sense.
And we were fortunate at the time in March that we had raised cash for hub accounts. And just the timing ended up working well. Obviously, not trying to predict this stuff. But we had the long-term strategies of setting cash aside after strong rebounds that don't seem sustainable. Makes a lot of sense. And the other good thing to learn was energy prices. We used to try to forecast out energy prices. This year was a great example of how difficult that can be. That's the chart we had on the slide. This was in percentage terms, not in dollars, but energy prices spiked throughout the first 4 or 5 months of the year, over 20%, pulled back, and we're actually down at the time of clipping this chart, just showing at that time there's a lot of momentum driving up oil prices and fundamental reasons backing it, but everyone was saying energy prices are going to 100, and they peaked in around 90, and now we're around 70. So 30% off where some of what you would think would be the best, most informed people in the oil markets making predictions ended up being nowhere close for the year. Something really, really difficult to forecast. Then we moved to Q3. Equity trends, they recovered after Q2, after some of that settled down, and continued to trend higher. Assassination attempts, changes in the Democratic nominee. We got to maybe one of our favorites throughout the year, the yen carry trade. Something we've been doing this a long time. I don't think we've ever discussed the yen carry trade before.
I think this is one of my favorite that we've done so far.
Yeah.
It's getting into that.
And
Hopefully it wasn't too much inside baseball, but.
And we'll throw up a quick slide, just to throw it up. It's the long term. There's always a reason to sell. Some headline that's creating fear for selling. Well, the yen carry trade got added to that. And it was something you felt significantly in the short term, almost a 10% pullback in equities during it. We got lucky that Jeff Weniger, actually one of the largest Japanese equity bulls that we know, was in town, and we had planned that long before this had happened, we were going to come talk about it. So we did get a good chance to talk about the carry trade. Some of that trade may be piling back up. The fear about it is gone. So it's something that we may see again. Right? We went a long time without seeing it, but I don't think the fear will push the market down 10% like it did last time. And we set new records for S&P concentration. The S&P 500 started the year, and we had talked about it, that it was already very concentrated,
Yeah.
but it continued. The top 3 companies in the S&P were 17% to start the year. Top 10 were 32%. Well, that continued to grow. Top 3 was 20%, and top 10 was 36% at the time we clipped this. This chart is actually from our diversification deck, where we talk about those stocks. They're great businesses. We talk about them all the time. Doesn't necessarily mean it's a bad thing to be concentrated. It just means there's risk in those names. So it's in our diversification for risk mitigation. But of course, this can continue if those businesses keep performing well.
With this much concentration, the idea of diversification is kind of how the S&P 500 exists, right, as an index, and people say, go to that, but there's now a lot of concentration in that index. But like I said, it's not a bad thing. One of the things that's probably driving this is AI, because a lot of these companies are directly or indirectly going to benefit from that trend that we're seeing in the market.
And we talked about, what forecasts for 2025 would look like. The ultimate contrarian view right now is that this continues. Nobody, very few people are forecasting out that concentration continues to grow. Same way entering this year, where we were contrarian and thinking it would continue to go. Not a lot of people are thinking that continues into 2025. So it's something, when we roll out our 2025 outlook, we'll be discussing. And the other thing that happened in Q3 was there was a rate cut. We had gone since 2022 over 525 basis points of increases throughout the year. And then in September, we got a 50 basis point cut. We talked about that one, that we thought it was aggressive to cut 50, but that last raise that they did probably wasn't needed. So it was really just pulling back a little bit of what they had done. But going forward, looking at how many rate cuts there's going to be, they've been reducing their forecast for rate cuts, thinking the economy is fine at higher rates. We've been saying internally that once we've pulled back from that 5.5% rates, it's really reducing risks. The chances of rates at 4% versus 2.5% is a lot different than being at 5.5%, where it's really still restrictive. But the economy can handle 3.75%, 4%. Fed fund rate.
So our projection on the reducing rate cuts means that the rates are probably going to be pretty stable going forward. We don't see increases and we don't see decreases in the rate by the Fed. Yet to be seen, but
right.
That's what the market has as a consensus, and that's what we view.
Right. And it's a difficult thing to forecast. We can go back to this slide. We've changed our formatting on the slides, but this was clipped from the beginning of last year's outlook, or this year's outlook. And we had predicted, we hit the midpoint because we were disagreeing internally whether it be 4 or 5 rate cuts. Ended up being 4. So that's how we got on our chart there, the GWS 112.5. Here's all the other forecasts. The CME futures, that's the one we pull up a lot to quote what the market's pricing in, at least from the futures market, was saying there'd be a little bit more than that. a few people predicting significantly more than that, and Goldman Sachs and the FOMC both said there would be less than that at the time. So forecasting out is really difficult. And like you said, I wouldn't be surprised if we're a little bit lower than this when we're forecasting out, I'm saying forecasting out similar expectations.
When we look at the dot plots, which are the 12 people that are making the decisions and what they predict what we'll do, and they're not even good at predicting what they will do. So
Exactly. And then we move to Q4, the election. Decisive election, equities rally, and there's this broad-based participation that has gone away the last few weeks. It was really, we charted here, we did small cap index, the S&P 500, threw the financials in here too to see how they reacted, and then international stocks. So the US domestic rallied strongly, small caps, and that's starting to pull back a little bit, while the S&P still continuing its rally, led by some of that concentration we just talked about. Analysts were chasing this market up. When they started the year, they missed this by about 15%. Their targets were 15% below here, so they're chasing it, raising targets for next year about 10% higher than where the market is now. A lot of that leads to the tough question, which is, have we moved too far? Right? A bunch of bears, notable bears, we're not going to mention, have thrown in the towel the last couple of weeks, that have been bearish for many years, have finally said, I was wrong, right? I missed the AI trade. So a lot of that's happening, and gets to the tough question, is this a bubble?
So what is our answer on that?
When we look at the data, we would say it's not like the 90s.
Right.
Stocks are certainly elevated. Stocks are pricey. We charted on the right here is a 6-year chart looking at the peak in the 90s, the late 90s rallying up. You can see the peak was about almost a 600% return before there was that significant crash coming down, versus the NASDAQ now, it's only about 200% return. Fantastic return. There was still a lot of junk in the index. Of course, there's really good businesses in that index now, but the returns were very different.
Well, and I would look at that big spike. I mean, that's a telltale sign that you're in a bubble, right? That is the mania phase of the bubble. And to your point, when you look at the current situation, we don't see anything that resembles that rapid spike. Maybe it's a year away, but as of now, we're not seeing the mania phase of a bubble in the prices.
And we quote the sentiment indexes, the surveys, even though they're not necessarily tradable. A few people have tried to run reports on, can you make this into a trading strategy? It's more of something just to be aware of. The individual investors, the bearish survey was really low. 30% bearish is pretty low for that. Generally a sign that the market's getting a little offsides. And the exposure of active managers at 99% is active managers saying they're fully invested. Mm-hmm. They can go over 100 with leverage, but the exposure index is, at least from a survey basis, saying pretty much everyone's getting invested, at least now. But we get into a great seasonal period. We talked about that earlier. The odds of a Santa Claus rally, which is the rally in the end of December, early January continuing, is about 80% of the time. What we're doing internally, really diving through strategies, finding where's the best spots to rebalance, what are some of these areas that get thrown out. You get some sectors and individual stocks get thrown out at the end of the year just based on whether it's tax loss harvesting or other reasons, taking gains because they can. And a lot of times the trend just continues. Something we're seeing with some of the big names like Apple just continuing to rally, even off some tough headline news events in the last few days where the S&P's down, Apple's been up. So you see a lot of managers chasing that, just like the analysts are chasing their targets.
So I think it's wise to be cautious whenever you find yourself and aligned with everyone else that there isn't a bear. But it may not just be groupthink. It may be that we may be moving into a good economy. I know if you're looking at different sectors, you can make a case that manufacturing and transportation and others have been in a recession for quite some time, which would make sense considering the monetary policy. If we're just stable and we're moving down and inflation is cooling and things are getting to a stage where whoever was elected, it didn't matter. We've kind of gone through that. I think there is a bullish case. Obviously, you always want to question that understanding, especially whenever you're not going to have people on the bear side to put a bottom to a trade that's missed. But I can't help but say that I think 2025 is shaping up like it'll be a good year.
Mm-hmm. It's the hardest part is doing exactly that, which is it looks like a great setup for the economy. Did stocks overprice that in? Did they already price in some of the strong move that you're going to see in the economy, right? And of course, we know they don't ring a bell at the top, but Trump rang the bell at the NYSE last week, and he had the same view. They asked him about stocks. He wouldn't answer stocks if they were going to go up or down because he said there's volatility there. I was impressed that he knew that. I know he follows the stock market and grades himself on that performance, but he's had the same view. He's obviously very bullish on the economy, as he should be coming in with his administration. But I think we're taking a similar approach to stocks, like you said, cautious, find areas that are working and try to avoid some of the spots that seem overvalued. Thanks for joining us this month. We'll be back next year with our 2025 outlook.